Hey there, it's a great day to sell a house, so let's talk about what a seller needs to know about the lending process, and also what is the difference between a mortgage pre-qualification and a mortgage pre-approval. So what is the difference? Well, a pre-qualification means that a lender has evaluated the creditworthiness and has decided that the applicant will probably be eligible for a loan up to a certain amount. Most often, this is a letter that is an approximation and not a promise. It's based solely on the initial information given by the borrower to the lender. However, it's not an in-depth verification of the buyer's ability to obtain a loan. A pre-qualification is basically a financial snapshot that gives a borrower the idea of what type of mortgage they may qualify and for how much money. So, what's a pre-approval? Well, a pre-approval means that a borrower has been fully vetted by the lender to qualify for that specific type of loan and the loan amount. It also means that the borrower's finances have been reviewed by the lender. This provides security to a seller that they are working with a serious buyer. One thing to remember, every lender is different. So it's very important for the seller to read the pre-approval letter thoroughly for any contingencies of the loan that could affect a seller's decision to entertain an offer. For example, the sale of another property. If the buyer has to sell another property in order to qualify for the loan, you may not want to entertain that particular offer. Otherwise, you may want to verify the property itself, whether or not it's been listed or whether or not it's under contract. These are things that are important to a seller. Here are some important things to consider about your buyer's financing. Never sign a purchase contract without receiving and reviewing a copy of the buyer's lender letter. Only a serious buyer will have their financing in place prior to agreeing to any terms for the purchase of a property. For this reason, you should always request a copy of that buyer's lender letter prior to negotiating any offers. This protects you as the seller, but also avoids wasted time. Be sure to check the expiration date as well on that letter. Is the buyer pre-qualified or pre-approved? Remember, being pre-qualified does not mean the lender has vetted the borrower. It only means that the general finance information has been received by the lender and that the borrower has the potential to qualify for a loan up to a specified amount. The pre-approved buyer is less likely to cancel a contract for financing purposes. What type of loan is the borrower using? Certain types of loans require by law closing cost assistance by the seller. Because they are government-backed, this is not something that can be negotiated, and so it is important for a seller to be aware of these requirements. What do you know about the buyer's lender? Are they local? Is it a bank? Or is it a mortgage broker? A mortgage broker acts as an intermediary between the borrower and the wholesale lender. Essentially, they are the sales force or the middleman for the wholesale lenders. A mortgage bank uses their own money to fund mortgages. This means the employees for the mortgage lender are directly working with the borrower and there is no middleman. An example of a mortgage broker would be Quicken Loans. An example of a mortgage bank would be the Bank of America. Having a local branch office for either of those can make the transaction more smooth. Okay, so every lender has to have an appraisal as a condition of the loan. So how does an appraisal affect a seller? Well, what is an appraisal? An appraisal is a comprehensive report on the worth of a property in the fair market performed by a trained and licensed individual. Why does the lender need the appraisal? Because the property being purchased will be used as collateral against the loan. That means the lender needs to be certain the property is worth what the buyer has agreed to pay for it. So how do you know the appraisal is a true depiction of the property's value? Because an appraisal is completed by an unbiased and impartial licensed appraiser. So whose interest is the appraisal protecting? Ultimately, the lender. However, the appraiser is chosen by the lender at random from a pool of licensed appraisers, and this appraiser should not be accessible by either side of the transaction, and this avoids conflict of interest. So what happens if the appraisal comes back too low? There should be terms laid out during the offer negotiation process, which should be listed in the contract should this happen. Usually the two options are cancellation of the contract or renegotiation of the purchase price. However, keep in mind, Certain types of loans do not allow for a buyer to absorb this loss. An example of this would be FHA or VA. The borrower would not be allowed to pay the difference of that appraised value versus the purchase price negotiated and accepted.